All right, so I'm just going to kick things off and get started here. The webinar will be available on the Pioneer Capital Advisory YouTube page after the fact. So if anyone joins late, I'll make sure to share the link with the recording via email. So, okay, a quick background on us. So Pioneer Capital Advisory, we're a commercial loan brokerage firm that is focused on helping business buyers with navigating the SBA financing process. And most recently, also the non-SBA independent financing process as well. I'm the founder and owner of the company. We've been around for 4 years. We started back in May of 2022. And on the SBA side, we have helped about 150 business buyers collectively borrow $330 million of SBA financing for all different types of acquisitions, everything ranging from roofing company purchases to e-commerce businesses, trades businesses, landscaping, environmental consulting, and much more. So this is the first iteration of biweekly office hours I'm planning to do to cover different topical content that's important in the current SBA landscape. One specific topic that I've seen come up a lot is seller financing. And so seller notes play a very important role in business acquisitions. And so I'm going to go through this deck on seller financing and specifically how I'm seeing it in the current environment, as well as what the SBA requirements are to really differentiate between what's required versus what banks like to see. And at the very end, I'm going to open it up for Q&A. So if anyone has questions, we're going to save them towards the end, and then I'll just field them as they come in. So just to get started here, the topic of today's webinar office hour session is the seller note, friend, foe, or both, and basically how to think about it. So just diving in here on the first slide. So the seller's note is one of the topics that comes up the most in any conversation that I'm having with buyers that are looking at submitting LO on business acquisitions. And one of the specific reasons why, candidly, is that the seller's note allows you to mitigate risk by keeping the seller involved by not fully getting paid out at the time of closing on the purchase. And so it allows the seller to have some economic chips on the table after the acquisition so that they're not basically getting fully paid at closing and then walking away and not being helpful for the acquisition. So nearly every SBA acquisition that we've advised on at Pioneer includes some form of seller financing. It's the most flexible piece of the capital stack, and it's very misunderstood. And so it allows you as a buyer to bridge things like seller financing gaps, basically the valuation gap between what you're paying for the business relative to what the business valuation comes back at. It shows that the seller has confidence in the business transitioning successfully after closing. And it also has the ability to reduce the amount of cash at closing that you need to bring. And so the first kind of thing here to keep in mind, especially if you're newer to the ETA space, is for any acquisition that you're pursuing with SBA financing, you always have to have 10% minimum equity injection for a full change of ownership. And so what that means specifically is the purchase price of the business that you're buying plus everything else that's involved. So let's just say, for example, you're paying $850,000 to buy a business, but then you have $150,000 of other stuff, including working capital, your attorney fee, your quality of earnings report fee, the SBA guarantee fee, and bank closing costs. You have to have $100,000 of equity. Now, the SBA allows that equity to all be cash from yourself and investors, or you can actually split that down the middle with the seller, and half of that can be cash, and the other half of that can be a seller's note on full standby. Basically, meaning that it's a seller's note that's just accruing interest while the SBA loan's outstanding. Once you pay off the SBA loan, you can either start making payments on that seller's note, or you can pay it off in full. So second point here is most SBA lenders in the current environment really want to see a debt service coverage threshold of 1.25 or above. So they're essentially looking at how much cash flow there is to repay the SBA loan, and then they're dividing that by annual payments that you're going to be making after closing to both the SBA bank along with any payments that were made on the seller's note. Kev, third point here was just talking about the full standby with seller's notes. So you can use a seller's note to cover up to half of the 10% down. Kev, progressing here to the next slide. So what a seller's note actually allows you to do for a deal is you can bridge the gap between what the bank is ultimately going to finance and the purchase price. So let's say hypothetically, you're looking at buying a company that signed a lot of contracts in the last year. Let's just say for discussion purposes, it's a property management company. And the debt service coverage of the business is increasing year over year due to new contracts that have been signed. And you as a buyer fundamentally feel good about the value that you're offering in the LOI, but the valuation from the SBA bank comes in below what your offer price is. So basically, the SBA only allows the bank to lend up to the maximum. The maximum the bank can lend is going to be the value that comes back in that third-party business valuation. So the gap between your purchase price and what the business valuation comes back at can come from one of two different places. One is cash equity from you and investors. The other place is seller financing. And so if you're in the middle of an M&A deal with SBA financing and the valuation comes back at less than the offer price, if you still have conviction pursuing the deal, you can ask the seller if they can bridge the void to basically allow you to pay them the price that you've gone under contracts for, but they end up holding more paper. And so that's something that we've seen before on deals that we've worked on, is when the valuation comes back lower, but buyer and seller still feel good about the price, instead of the buyer putting more cash into the deal, the seller ultimately increases their level of seller financing, or they hold a different seller's note, oftentimes either on just interest only or accruing interest, so that it doesn't adversely impact the debt service coverage. So just to give a little bit more texture here with this example, if you have two different deals that are the same price, you can finance both differently. And it's not, the question isn't simply what's the price, it's how much of the price is getting financed by the bank and on what terms is the seller going to carry the delta. And so basically, when the coverage becomes too thin, you can move debt onto seller financing instead of basically just having it be amortizing financing from the SBA loan. And so banks look at seller financing through a couple of different angles. And one is essentially, is the interest rate on the seller's note lower than the interest rate on the SBA loan? So SBA loans are generally going to be prime plus a spread. Prime as of today, June 25th, 2026, is 6.75%. And then the spreads over prime vary. So I've seen deals done at prime plus 0.25%, fixed in increments, all the way up to prime plus 2.75%. So that ranges between 7% to maximum 9.5% currently. If you have a seller that's willing to hold seller financing over the same amortization period as the SBA bank, which is going to be 10 years if you're buying a business without commercial real estate involved, and if you're getting an interest rate that's lesser than what you'd be paying the SBA bank, it helps your debt service coverage, which is super important. But second order factor, it shows the bank that the seller believes that this business is transitional because they're willing to leave chips on the table and not expect to get fully paid out at closing. And so it reduces the amount of cash that you need to bring to the deal if you're able to get the seller to hold the seller financing on standby, which is more rare. But it also can help your debt service coverage, because if the seller is willing to have part of the seller financing be on interest only, and also if the interest rate is better than that in the SBA loan, your monthly payment from a DSCR standpoint is going to be lesser. So moving on here to the next slide, this kind of topic covers full standby seller financing. And so full standby seller financing essentially is the way that you can have a seller's note count towards your down payment. What I would tell anyone that's joining this call here is that it's candidly very rare in the current environment with how competitive it is to get a seller to hold their note on full standby. Sometimes what I've seen people do is they'll put two LOIs in front of a seller, one that has a higher top line offer price and one that has a lower top line price. And in the offer that has a higher headline price, they'll ask the seller to hold a seller's note in full standby to help the buyer with accommodating up to half the 10% down. And so functionally speaking, the way it works is very much how it sounds from the name, is you have a seller's note that's just accruing interest while the SBA loan's outstanding. At the point in time that you pay off the SBA loan as a buyer, you have the option that you can either, one, start making payments to the seller's note, or two, you could refinance it out with the recapitalization. The deals that I've typically seen get done with seller notes on full standby are generally for business acquisitions that are sub $2.5 million. Because if you think logically about the subset of buyers that's buying in that range, there are more people in that range that are going to need to be creative and entrepreneurial with coming up with different forms of the down payment than when you're buying a bigger business and you're competing with more capitalized buyers and or potentially strategic buyers and sometimes private equity firms that are doing an add-on acquisition. So the fourth bullet point here is one that I want to touch on in this section in blue on the left-hand side of the screen regarding the SBA standby agreement. So for any seller's note, regardless of if you're using it towards a down payment or if you're not using it towards a down payment, you always have to have a document signed called the SBA Form 155 or the standby creditor agreement. That document in essence says the seller is a junior lender behind the SBA bank. So if you as the buyer cannot make payments to the bank, you have to pump the brakes on making payments to the seller. The wording of the form being called a standby agreement versus subordination agreement often throws people off, specifically attorneys that are reviewing the agreement for the seller, because the attorneys and the sellers read the word standby and they presume that means that you can't make any payments. The differentiating factor here is as long as the seller's note is not being used to come up with the 10% down, you can start making payments on the seller's note the month following closing. And the terms and conditions of that seller's note just need to be such that both you and the seller are fine with them, and the bank that's ultimately doing your SBA financing is ultimately fine with them too. So key differentiating factor here is the only document that is required with any type of seller financing is this SBA standby creditor agreement. And the only time that a seller's note has to be on standby for any duration is if you're using it to come up with a 10% equity injection down payment for the SBA loan. Otherwise, the terms of the seller's note can be whatever you and the seller ultimately agree on, as long as it works for both you and the seller, along with the bank, and the debt service coverage works too. So going to the next slide here, I just want to give an example of a capital stack with a $2 million acquisition so that you can understand the curvature of how this ultimately works. So in the example that you're buying a business and the purchase price plus the working capital, so working capital is essentially cash to the balance sheet that gets financed into the SBA loan. It's basically a bucket in the loan budget. If the purchase price is $2 million, and then you also have working capital, your attorney fee, financial due diligence, the SBA guarantee fee, and bank closing costs, totaling to about another $200,000, which brings you to $2.2 million total, your SBA required equity injection is 10% of that $2.2 million, which in this case would be $220,000. With the current SBA guidelines effect as of today, June 25th, 2026, you can essentially split that $220,000 down the middle, and the seller can hold a note for half of that. So for $110,000, that can function for half of your down payment. And so basically, if you're either short on liquidity and or you have a seller that wants to sell to you, but you can't come up with that 10% down, and or for whatever reason, perhaps you don't want to bring in equity investors to complicate your ownership table or structure, this can be a very powerful lever that I've seen buyers ultimately get sellers to agree to and close on deals. Moving on to the next slide here. So before the SBA guidelines changed, most recently in June of last year, so June of 2025, the SBA allowed, if you had a seller's note on 2-year standby, so 24-month standby, that could count towards the down payment. So that was the case between 2023 and in June of last year when the guidelines had previously changed. Last year, the SBA changed the guidelines back to what it was before, where now if you want a seller's note to count towards the down payment, it has to be on full standby. It can no longer just be on the 24-month standby. So that's one thing that I've seen buyers missing on, especially folks that have been in the ETA space since before June of last year, because the guidelines used to allow that and accommodate that. And for better or for worse, they've now changed, that only allowing the full standby for the down payment. So a second miss that I've seen people make on seller's notes is they have a bigger seller's note, so they oversize the note, and it ultimately ends up breaking debt service coverage. And so to give you an example here, let's say that you want the seller to have a seller's note to be financially motivated for you as the buyer to have a smooth transition period where if the transition period does not go well, they're ultimately not going to get paid on the seller's note. You end up deciding that they're going to hold a big seller's note, but the repayment period of that seller's note is going to be over 3 years. If you think about things logically on the margin, if you're making payments on a seller's note over a 3-year schedule, let's call it at an 8% interest rate, you're going to end up making a higher monthly payment than if you stretch that same amount of financing on the SBA loan over a 10-year period and you're paying the bank 9%, because you'd go from a 3-year repayment period with the seller's note to a 10-year repayment period with the bank. And so the takeaway with that second point essentially is it's not always better to have a seller's note just to have it. It's only better if having the seller's note improves your debt service coverage. And so you need to think both about the amount of the seller's note, the interest rate of the seller's note, and then also the term and the amortization of the seller's note. So those last two factors should not go neglected by any means. The third thing here is waiting until far along in the M&A process to talk about standby. So lots of SBA banks really like to see when a seller's note is on standby either for the first 18 months to 24 months. The specific reason why is that if your deal goes sideways and you default on the SBA loan in the first 18 months after closing, that's the SBA's early default period where the bank effectively will get hosed by the SBA. And the SBA is basically going to put the onus on the bank to explain why you defaulted so early. Was it that the bank did bad underwriting? Were you not properly capitalized with the right amount of working capital? Were you not the right operator based on your experience? Any kind of form of those questions. And within the first 2 years, it allows the bank sometimes to keep the seller's note payment out of the debt service coverage, depending on their underwriting standards, if they look at the first 2 years of projections versus the first 3 years. And so what I would tell you as a potential business buyer listening to this webinar here is if you're negotiating a seller's note if you can get standby for that first 18 months to 2 years, and you have interest payments or interest that's just building during that period of time, it increases the pond or number of banks that might want to do your deal, all else equal, because it gives you some breathing room from a debt service coverage perspective. So the fourth factor here is treating the seller's note as a price fix. And so a seller's note, if you're overpaying on valuation for a business, you should never basically just use the seller's note as a wedge to pay the same price if the business valuation is coming back substantially below the LOI price. So let's say hypothetically, just to give a hyperbole here, if you're under LOI to buy a company for $4 million and the valuation comes back at $3.4 million, you have a $600,000 delta, you shouldn't just bridge the gap with seller financing. You should probably have an honest conversation with the seller to see if they'll come down valuation. If the gap is smaller and it's not something of consequence, that's when it can make sense to use the seller note to shoot the gap. But if it's substantial, you really probably should be renegotiating on the purchase price. So moving on here to the next slide, kind of covering different ideas on negotiating terms and conditions with the seller's note. So if you think about things optically, the bank in most SBA deals is going to be lending the vast majority of the capital stack for you to buy the business. And so generally speaking, if you're getting a seller's note, you want the interest rate to be below that of the SBA loan, not more and not equal, especially if the amortization schedule is shorter. Because on the margin, if you're paying the seller a higher interest rate than you would to the SBA bank, it makes sense to just pivot those dollars to the SBA loan so that you're getting a better debt service coverage. Similarly, kind of along that same vein, if you're only going to get a 5-year amortization on the seller's note, and maybe the interest rate's the same as the SBA bank or only slightly better, it's still not good for you, because even though you're getting the seller's note, your debt service coverage is going to get truncated and reduced due to the fact that you have that faster payback period. Kev, third bullet point here is on standby and using a seller's note towards part of the down payment. And so if you know that you're going to need the seller's note to function towards part of your down payment, that's a conversation that you want to have leading up to the LOI process so that you have that expectation set with your seller at the onset. The last thing that you want to do as a buyer is try to retrade and renegotiate that during the diligence process and tell the seller, okay, by the way, this $300,000 note you thought you were going to be getting paid on after I bought this business incrementally in monthly installments, I'm actually going to ask you for a 3-year standby or full standby. That does not go well. And I've seen people try to maneuver on the seller's note when it's not justified in the financing process. And that typically correlates with deals ultimately dying. You want to mention the subordination requirement with SBA financing on the seller's note, because it's something that you know is going to be required. And the last thing that you want is for that to come as a surprise. So I tell buyers, when you're writing your LOI, include mention in parentheses or somewhere in the seller financing section that the seller's note or the seller is going to be required to sign SBA Form 155 standby subordination agreement as part of the seller financing. Some banks use a different form. I've seen there's a document called Debt Lien Subordination Agreement, which is basically just a synthetic variation of the SBA standard form. Some banks will use that instead. It's essentially the same in substance. It just uses different legalese. You just want to include mention there will be a subordination agreement required for the seller financing so that it does not surprise them at the last minute. The last thing is you want to make sure, and this is more of a legal thing here candidly, that if you're going to be required to secure the seller's note, that they understand they're going to be subordinate to the bank. When a seller involves their attorney, especially after the LOI gets accepted, a lot of the time the attorney tries to find a way to secure the seller's note. And this typically comes up because the seller, essentially, the bank is going to take a first lien on all the assets of the business. If you're doing an SBA loan, you're going to have to personally guarantee the loan. And so they're a senior secured creditor. Now, the seller, since they're signing the subordination agreement, they're behind the bank. And so if they want to file lien on the assets of the company, they're going to be in second lien position, which is effectively worth nothing in a liquidation scenario, since most of these SB deals are highly uncollateralized. So sometimes I've seen the seller wants to take a lien on your residence. They might want to take a lien on marketable securities. What you really want to do is have the conversation with your seller, essentially explain that they're going to be an unsecured creditor. Sometimes I've seen buyers offer up a personal guarantee. That's not common, and it's something that people typically just don't have the risk propensity or tolerance for. But if you're going to offer that up, it's something where you want to have that conversation with your attorney to understand what that risk means, and also to understand the dynamics where if the bank has your personal guarantee, how would that look mechanically in a liquidation scenario? Last slide here is just going into Q&A. And before this, I guess just a couple of other things too, as far as seller financing is concerned. There are different other creative ways that I've seen people use seller financing. For example, forgivable seller's notes, similar to if you're buying a business where you're worried that earnings are going to revert back to what they were in a prior time period, and you want to have some pillow or buffer. There are different ways that you can go about structuring seller's notes to give you some additional risk protections. And so those are specific things where when we're having conversations with clients at Pioneer and when I'm speaking with people, we give our input on different ways that we would recommend structuring and approaching seller financing so that you can really try to, one, reduce as much risk as possible in the deal. And then secondly, making sure that the deal that you're putting together is one that's ultimately going to get financed by an SBA bank if the structure holds. So last kind of disclaimer here before jumping into Q&A. So all this information is just for educational purposes. I'm not your attorney, accountant. I'm just an SBA loan broker. So anything here as far as kind of personal guarantees and legalese, you need to validate independently. But with that, I'll open up to Q&A. So if anyone has questions, feel free to drop a comment in, and I will answer any questions as they come in. So thanks everyone that's joined here. For anyone that doesn't have questions, that wraps up the presentation. So I'll just hang out for a few minutes here. Okay, question from Gonzalo. Who is the biggest obstacle in getting a seller note to the finish line? The lender or the seller? Does the picture change in non-SBA loans? So what I would say typically, Gonzalo, is most often, assuming the terms and conditions in the seller's note are beneficial for you in the way that you're capitalizing the deal, it's often going to be the seller that I've seen being the biggest obstacle as far as potentially having a change of heart and wanting to provide the seller note and or wanting to throw some last minute monkey wrench. So whether that's asking for a personal guarantee to secure the seller's note or asking for some type of securitization, it's super rare that the lender ultimately it impacts or kills the seller's note. I've seen it happen before on one deal specifically where it was a buyer buying an e-commerce company that had only been around for about 4 years. The chief credit officer at the bank decided essentially to put a debt service coverage hurdle in the seller's note to restrict payments from taking place if the DSCR on the SBA loan fell below a certain threshold. And so that almost derailed the transaction from closing. But generally speaking, other than that, it's when the seller's attorney or the seller themselves decides that they want to try to secure the note in some way, shape, or form, that's just not going to pass muster with the SBA. So that's what I've seen there. Question from Pinkaj, if I'm pronouncing your name right. Can you go into more detail on what the restrictions are for forgivable seller's notes? So what I've seen as far as restrictions, or framing it from what I've seen work, is when you pick a historical metric, generally a historical financial metric that the business has met before, let's say trailing 12-month EBITDA, or last year's sales, or retention of a specific customer at a specific percentage, as long as it's a historical bogey that's very quantifiable and understandable for a bank and their underwriter, that's generally something that I've seen get done before. Now, when someone tries to make it more forward-looking, let's just say, for example, you're buying a company that's only done $4 million in sales, and you're basically trying to create an earnout of sorts, and you want the business to do $4.5 million of sales. I've sometimes seen people reach out and in their LOI structure, it says, if the business does not do $4.5 million of sales in whatever specific time period, the seller's note will not get paid or it will get forgiven. That does not work, because that's essentially kept backing into an earnout. So as long as your bogey that you're putting in the seller's note is something that the business has achieved before, that's generally something that will pass muster with most SBA banks. And one additional comment as well is the forgivable seller's notes. These have now been super mainstream for the last 3 to 4 years. And all of the blue chip SBA banks that do lots of deals in the ETA space are more than familiar with this topic. And so if you're running up against anyone that's not familiar, feel free to reach out to myself or any of the big name banks, and most people will be able to help you. A question from anonymous attendee. Have there been any recent changes to the SBA loan program? So I guess, question back to you, is the question on changes specific to seller financing or changes specific, like just in general? So back earlier this year, for example, there were changes on now everyone in the cap table needs to be a U.S. citizen, which before wasn't the case. So I just want to make sure I answer the question as directly as possible. So question on, are there any additional nuances for seller notes with conventional lending and non-SBA financing? What I would say there, Kev, speaking in broad brush strokes, in most of my experiences on the SBA side, essentially there's going to be more fluidity to what you're allowed to do as long as it works from the standpoint of that specific lender. And so generally speaking, in the SBA lending land, if you want the seller's notes to count towards the down payment, it has to be on full standby, they have to sign a subordination agreement. There's going to be more negotiation, Kev, within reason as to how you're capitalizing the deal. So I have not heard of a non-SBA lender allowing a seller's notes account functionally for equity. But as far as being able to do things like forgivability and similar, I would personally suspect that you might have more options, but I can't intelligently answer that question. So as far as the eligibility requirements and conditions, the biggest change I would say candidly is one on the U.S. citizenship. And essentially now every single person in the cap table has to be an American citizen. And then the second big change, and there have been some more minor ones, is that effective July 4th, there's essentially going to be a decoupling between the limits with the SBA 7A loan program and the SBA 504 loan program, where you can do $5 million for each of the two. Happy to connect on a Zoom call and answer any specific questions as well, just for anything that you wouldn't want to ask with the broader audience here. So feel free to ping me on LinkedIn or shoot me an email. Okay, question from Eric Bauer. If the bank is requiring more than 10% equity towards the deal, say 20%, can the seller's note still cover 50% of the equity requirement, or is there a cap? So essentially, Eric, the seller's note can cover My understanding from a high level is it can count up to half of the down payment requirement. I have candidly yet to see a deal where the down payment requirement is over 10%, unless the multiple is super high to a degree where like it just doesn't work with 10% down. But my understanding is, generally speaking, the seller's note, if it's on full standby, can count up to half the down payment. So with that, folks, I'm just going to wrap things up here just to give everyone the last 23 minutes of the block here back. But for anyone that wants to reach out, I basically speak with business buyers every day of the week, Monday through Friday. Feel free to shoot me an email to Matthias@pioneercaps.com, or feel free to reach out on LinkedIn as well. I'm pretty findable there. Or if you're on Twitter, my handle is my first name, Matthis. So thanks everyone that joined. Happy to answer any other questions, and have a great rest of your week, and happy early 4th of July. So cheers.